Hey everyone, Eric here. In this video, we're going to learn how to think through and solve a finance case study, the type very frequently given in technical finance interviews or coursework in universities. By the end of this video, you will understand how to solve a case study and give a recommendation at the end. Okay, let's get started. So first off, the setup for almost all case studies is the same. You're given some sort of information, set of facts about a company, and they're usually at some sort of critical juncture in the history of the company where they need to make some new decision, start some new thing, make some change in the company, make a decision about some, thing that they're considering. So you're given all of their facts and you're supposed to analyze them. Usually you build some sort of a financial plan like an income statement, and then you give a recommendation at the end. And that's where you can kind of put your own flavor on it, talking more about strategy or risk or some of those more qualitative metrics as well as your analysis. So here's a set of facts that I made up for a finance case study, but this is very typical and it encapsulates the key concepts. So in this situation, we are a SaaS company. So we are some kind of software platform and we sell our platform as a service. So we are considering a partnership with another company. They want to use our software platform, white label it, meaning take our name off of it, and then sell it to their clients. So basically use our technology but sell it. And then what we would ultimately do is we would have a revenue share between the two of us. And we're trying to figure out if we think that is an interesting proposal and if we should move forward with it. So, the price per customer, this other business, is going to sell it to their customers at $40,000 a year. They then will pay us 40% of that revenue, and that will be our share of the revenue. And then they have said that they expect in the first year of operations, they could onboard 2 customers. Then in year 2, 25, in year 3, 100, and then in year 4, 150. So let's just put that in right here. 2, 25, what did I say, 100 and 150, okay? So then we estimate that the cost in terms of support reps for each customer account of this white labeled platform is $2,000 a year. So $2,000 per account. And then we think the hosting costs, that would be like Amazon Web Services and different hosting applications, is $500 a year per new customer. And then finally we've estimated that we would need to basically open a small new office for this team that's going to be in charge of white labeling our platform and supporting it. So the new office is $75,000 a year. The payroll for the white label team is, if we're excluding the support reps, is $600,000 a year. That's like the fixed overhead payroll. And then the upfront investment, which is the CAPEX of the white labeling platform, we're going to need to invest $750,000 before we can basically sell this platform to a third party as a service. So this is our CAPEX. It's the upfront investment. So we've been asked to find, and again, with finance case studies, you're always basically solving for the exact same metrics. So once you see this, you'll see that you basically are doing the same math every time, but there's just small variations in the initial numbers that they give you. So you're solving for revenue, cost of goods sold, gross profit, operating expenses, operating income, net income. So the whole income statement, you want to basically build it. And we can do that. But one thing that will be definitely missing is, first off, depreciation. We're going to have to calculate depreciation because we have a CAPEX investment. So there'll be some assets that we're needing to depreciate. And then the next thing is the basically P&L versus cash analysis. So when you're thinking about the income statement, anytime you're buying assets and depreciating them, the cash impacts will be different than the net income. So you want to break down the difference in your analysis. And that's going to be very typical in all finance case studies. So let's kind of get started and look at these initial points here. So first off, we have some of the initial information. So let's put some of the years in. Year 1. Okay, so year 2. And we can probably just drag this forward. Year 2, year 3, year 4, and space it out. Okay, so now I always like to put some nice, and if you can, try to use Excel without the mouse. So Control B, bold, Control U, underline, Alt H, and now I'm going to hit AC to center it, AC. And the more you can do without a mouse, here, Shift down arrow, Control C, Shift right arrow, Control V. It makes you faster, and it will also show your interviewer that you have good Excel skills. And if you have strong Excel skills coming right out of college, it makes you much more valuable because you might not have as much experience, but at least you have the technical background to be really productive. So if you don't know how to use Excel without the mouse, I actually have a course that teaches mouse-free Excel. Check it out in the description below. It could really help. Anyway, so let's get back to the video. So the next, support rep cost per account. So here's what we're trying to differentiate. Is this in the cost of sales or the operating expenses? Well, the cost is per account, so it's directly tied to the revenue. So we know in this case, this is going to be cost of sales. And hosting cost per account, again, a direct cost. For each individual additional account that we have, we need to pay for more hosting. But what about Office? Office, that's an operating expense. That's going to be flat every year. So is the overall overhead payroll for white label team, and the CAPEX is only one time. So we know this stuff is going to be in the operating expenses. In the CAPEX, let's just insert a row so it can kind of be in its own section. Okay, so I'm actually going to move down one row and check this out. Go here, click View, freeze panes, and that's going to make it so that no matter where I go, I don't lose my titles in the top row. Okay, so let's start. First, let's find the revenue. So the revenue is going to be the number of clients we have, of course, times the price, times our share of the revenue, 40%, right? Okay, that would be the revenue to us. So that's our revenue in this partnership. So the revenue, we can just hit Control C, Shift right arrow, Control V, okay? So now we have our revenue, and it gets to 2.4 million. Next, we have cost of goods sold. We know it's these two items. And so let's just break that out. I'll show you, I usually insert rows just with the keyboard. Alt, Home, I for insert, and then R for rows. And if you just tap F4, you just repeat the same function. That's a nice trick. Anyway, so with cost of goods sold, I'm going to just link in these two titles here. And then what I can do is hit equals. I go support rep, 2,000 per account, times number of accounts. And I'm going to start tapping F4, and right there I'm going to lock the row. Okay, so if I copy that to the right, that's going to work. And if I copy that down, because I locked the row, the row 11, the number of customers stayed in the same row, but the hosting cost, the row reference actually moved down one cell. So I can use the same formula 8 times because I locked the row. Okay, so now we have our total COGS, cost of goods sold, and I'm doing a little bottom border. And so you can see our total cost of goods sold is here. So let's make that bold here, that's shift space, bold. And now finally, we have our gross profit. So gross profit is always revenue minus COGS. And again, we can make this bold. It's good to bold the key metrics when you're building models and keep this stuff really clean and organized. Gross profit margin is just your gross profit divided by your revenue. And in this situation, it's 84%. And so we can just copy that across. And then finally here we have our operating expenses. So what is going to be in the operating expenses section? So here I'll do it with the mouse, but again, you know I like to do it without the mouse. So first off, we have our office for the team, of course. We also have our payroll, but then we're going to have depreciation. So, and I'll just, I'm going to shorten this up just so that it looks a little cleaner. Depreciation. So let's start by just linking in the office cost. So 75,000, copy that in. We can just copy this down one. Okay, here we go. And depreciation. So how do we do that? So we know there's a CAPEX build out of the white labeling of the platform. So basically taking our name off and making it possible to sell to a third party. So that is going to cost us $750,000 as an upfront investment in creating that new product. And so let's say maybe we pay a bunch of consultants to do it, and then they're able to build that for us, a bunch of software engineers. So in this situation, if the interviewer didn't give me a useful life, I would say, what would be a good accounting useful life for this platform? In general, software, usually you depreciate it over 3 or 4 years. In this situation, I'm just going to make the assumption that it's 4 years. So I'm going to go down to this section below and look at the depreciation. So let's take a look here. So depreciation, and I'll put a little underline bold. So we have our CAPEX, useful life, and this is just a little depreciation schedule. Very simple. So we take our initial investment, $750,000, and useful life, I'm going to say it's 4 years. And I like to put assumptions always, we can go into more colors, in a nice dark blue. That's kind of a good rule in business to always do that. And so for the depreciation schedule, this $750,000, we're going to spread it over 4 years. So we take this, lock it, divide it by 4, lock the 4, and then you can see, and we can just go here and decrease the decimals, that it's $187,000 a year. So this we can now just link straight back in to the operating expenses. So depreciation, here we go. Now that spreads that upfront investment over the useful life of the actual asset. And finally, you will have total OPEX. Okay, so let's say total OPEX, and if we spread this out, you can see that each year it's $862,000. So now let's look at operating income. Operating income is your gross profit minus your OPEX. So in this situation, we can see that in the first year it's turning a loss. In the second year it's turning a loss. In the third year it's actually making money. And in the fourth year it's making money. So again, on any kind of margins you have, it's good to put like a EBIT percent. EBIT and operating income are the same metric, earnings before interest and taxes. So you can calculate that percent here as a percent of revenue, so you can have that margin. And then finally, how do you get from operating income to net income? Well, assuming that you have no interest, the only other thing that would go in between those is taxes. And if this was a standalone company, you would take these losses and you could use these to offset future profits. So you like accumulate the losses here and you use them to offset taxes for future profits. But assuming we are part of a much larger profitable company, then actually we should just calculate the taxes in real time. So obviously you don't pay taxes on anything that's a loss, but taxes times, in the US, the corporate, the federal tax rate, corporate federal tax rate is currently 21%. It's moved around a lot over time, so we'll see how long that number is correct for. And you take operating income minus taxes, and this is your net income. So this is your net income. And one more metric that I think we should call out, which is really important, is EBITDA. So this is, one of the key metrics. And why is EBITDA important? Well, basically for businesses that actually make a profit, EBITDA is pretty close to operating cash flow, and it kind of gives you a better sense of how much money they're actually making when you sort of basically adjust out all of the accounting stuff around depreciation. So EBITDA is operating income, and then you add back depreciation. So you can see EBITDA is higher than your operating income, and your EBITDA margins are, and again, in our case study, they didn't ask for EBITDA. But the thing is, when you have a case study, it's your opportunity to show your knowledge of finance. So if you think something like EBITDA would be helpful, show it. And if you have something to say about it, even better. Okay. So now you can see the margins. So this business basically has a ramp up, but then in year 4, net income is 38%, EBITDA is 56%. So very high. So, okay, we know that it scales up very nicely. So what are the things that I want to answer? First, P&L versus cash flow analysis. So let's think about this. Let's do like a really mini cash flow statement, because I want to know how much cash do we put in and how much cash do we actually get out. So we can just take EBITDA, which is already your income statement with the depreciation added back. So we can take EBITDA, and here, let's link in the CAPEX. So this is really our net cash flow. So it would be EBITDA minus this upfront investment, and then this would be our cash flow. So let's look at this. So what is, really what's the payback period from a cash basis? So it looks like we rack up 1.7 million in losses, and then we make 2 million. So let's say if we just say like let's say cumulative cash flow. Cumulative cash flow. This would be a cool metric. We say in the first year we turn a negative 1.4 million loss. In the second year we turn another loss, but then we start making money. And in year 4 we've actually gotten a payback on our initial sort of upfront investment and year 2 loss. So our payback period in this case is slightly over 3 years. So that's a helpful thing to understand. So what else can we be looking at here? Well, I think this is the time, given that we've sort of crunched all the numbers, we've solved the case study, we have the full P&L here, we even broke out EBITDA, we created a depreciation schedule, and then we actually looked at our cash flow. Now we want to make a recommendation. Look at this information and figure out what does it mean. So I like to break recommendations just in terms of like quantitative things and qualitative things. So first quantitative thing to evaluate is P&L versus cash flow. Obviously you want to keep a close eye on cash flow. So the P&L, our net income gets to 40% by year 4. Okay. That obviously seems very appealing. That's a very profitable business. Our EBITDA margins are 56%. But do we dig ourselves a big hole with the upfront investment? Well, it looks like by year 4 we're actually breaking even. So from both of these standpoints, I think that this opportunity definitely is lucrative and makes sense. It's appealing. What about payback period? Payback period. This again, we just analyzed this. It's a little over 3 years. It's like maybe like 3.5 years. So that makes sense. So what about like how long do we think the partnership could last? Because when you look at this model, when I look at it at least, the only thing I think of is what does it look like in year 10? Is this $20 million in year 10? So how long? How long do we think the partnership could last? And I would ask that to your interviewer. And if he says, we think it's a long-term partnership, then, you can make the assumption that this business is going to invest, a couple $1,000,000 and make back tens of millions of dollars. What else? We could think about, how would we finance the project? How would we finance the project? Debt, equity, our own cash, because some businesses have a couple $1,000,000 on the balance sheet. Some businesses don't. What if we could take out a loan and finance this project and just pay it back with the future profits? Well, that would be convenient. And I think the final question would be, how do the margins compare to the overall company? Because there's some businesses where the overall profit margin of the company is like really, really high. Like, let's say our overall net income margin was 50%. A lot of software companies have like really, really high profit margins. Would we want to pursue something that has a 38% net profit margin if our core business is 60%? Maybe not. But if our core business is break even and has a 5% or less profit margin, maybe this would be really helpful. So understanding how this potential partnership compares to their overall company would be really, really helpful. So I would ask your interviewer that too. Finally, I think the thing that's interesting about recommendations, there's no right or wrong recommendation. You just want to basically take into account, all the pieces of information. So qualitative things. I think, like, what is the probability of success? Like, is this a partner that we've partnered with before? Do we know them? Are they a successful company? Like, it could be that this partnership is very risky. Like, we think it has a low probability of success. If that's the case, then risking a couple $1,000,000 up front could be very dangerous. So I would ask, how likely do we think this is to go forward? If this is an early stage startup, say, that has no customers, then the probability has got to be really low. But if this is a huge company and they're just they already have 10,000 customers and they're like, hey, we want to sell your platform to our 10,000 customers, well, then the probability that we can basically grow into their customer base is much higher. It's much less risky because they already have the customers locked in. But if they're like a brand new startup, then the probability could be really low. So you have to think about that. Also, what is the overall goal of the company? So this is an important question because, if we're part of a software company, does this software company really want to be selling to third parties? Do they want to be, insulating themselves? Is their goal growth or is their goal profitability? And so it's like, does this align with the overall sort of mission of the company, and does this help them take a step forward? I think there's always risks of a project. The first one is financial risk. Could this company afford to lose a couple $1,000,000 if this doesn't go well? Like, if it's a big company that has $1 billion on the balance sheet, then they probably will have a high tolerance for risk. So they'll say, we're just trying to invest this money in different opportunities. But if they're a tiny company and it's the founder's life savings, well, then that's a lot riskier, because if we lose that and this doesn't go well, then, we are screwed. So you have to think about, what are the risks? Technological risks. Can this other company steal our technology? Would they? Is this a sort of international partnership where they are under the rule of law of a different government? And if they stole our IP, could we sue them? And so you have to think about these things. And then I think the last one is operational, which is like, would we take our eye off the ball with our own business? So what if we're focused on scaling and this becomes like this big headache that distracts us from our core business, and we're trying to do this third-party thing, and we end up moving resources to this and it hurts our overall revenue? So that would be bad. And then opportunity costs. Opportunity cost. Are margins better or worse than other opportunities? So what other partnerships do we have on the table? If we invest this money in something else we're doing, maybe our core business, will we make more than this? So is this worth the opportunity? So my overall recommendation, of course you'd have to ask your interviewer about this stuff, is that the financial profile is very appealing. So as long as this poses no strategic risks to the company, I would go for it. Because if you look at the EBITDA, a lot of these companies are valued on their EBITDA. Let's say a software company could be valued, 50 times their EBITDA. So this sort of adding this EBITDA to the bottom line could be worth, let's say it's 30 times. It could be worth like $40 million of valuation to the company. So, should we invest $2 million or $3 million to increase our potential valuation by $40 million? Yeah, I think that's a no-brainer. I think you definitely need to move forward with that. But only as long as we have the money to start the project, and we could lose our money on the project and the company will still be fine. So that's what I would say. So, financial profile, very appealing as long as this poses no strategic risks to the company. Let's do it. So that's my recommendation. So I hope you learned a ton in this video about how to solve a finance case study and think through real-life situations. By the way, in the description below, you can download this Excel file completely for free if you want to use it for yourself. I've also linked down below to some of my finance interview prep and financial modeling videos as well. Check those out, especially if you're prepping for a finance interview. I have a whole series of videos on doing that. And if you found this content valuable, please subscribe and click the little bell icon so you don't miss any of my new videos. Like this video and leave me a comment below. And also check out my online courses if you need to improve your Excel and finance skills. That's all for today. Thank you for watching, and I'll see you in the next video.